You know, in real estate, seeing those profits on paper is great, but turning that paper wealth into actual spendable cash, well, that's a totally different ballgame. Today, we're diving into the modern playbook for cashing out, covering everything from smart refinancing all the way to the wild future of property ownership itself. So, right off the bat, let's just bust a huge myth. If you've been thinking that the only way to really profit from a property is to stick a for sale sign in the yard, you're missing out on some of the most powerful and profitable strategies in an investor's toolkit today. And that brings us to a really fundamental truth in this business. Buying a property right is only half the battle. Your real success, the thing that makes you the real money, is determined by how you exit. That's the plan that separates a decent investment from a truly life-changing one. This is what we're talking about when we say the art of the exit. See, the sharpest investors, they don't just buy a property and hope for the best. No, they buy it with a crystal clear exit plan already mapped out. They're thinking of it as a programmable asset, which is a cool way of saying they've got multiple pre-planned ways to unlock its value right from day one. So let's start climbing our ladder of complexity, okay? First up is a strategy you might have heard of, the strategic refinance. But listen, this isn't about knocking a quarter point off your interest rate. This is about strategically pulling out the cash that's literally hiding in your property's equity. And I want to be super clear here. This is not your typical homeowner's mortgage refi. A strategic refi is basically a capital recycling machine. You're not just saving a little on your monthly payment, you're actively tapping into the new value you've created in the property and pulling out your profits, all without having to sell a thing. Yeah, this slide just lays out the playbook perfectly. It's a simple, repeatable, three-step loop. First, you force the appreciation. You add value through renovations, better management, whatever it takes. Then you get a new appraisal that reflects that higher value. And finally, you refinance based on that new number and pull the difference out in cash. Simple as that. And this is the absolute best part. Because that cash you pull out is technically debt, it's not considered income. And what does that mean? It means it's a tax-free lump sum of capital that you can turn around and use to fund your very next deal. It's beautiful. So when does this move make the most sense? Well, it's absolutely perfect if you're playing the long game, trying to build that generational wealth without selling off your best assets. It's also the go-to move when you need cash for another deal, but you don't want to shrink your portfolio. And, of course, it can send your cash-on-cash return through the roof. Okay, now let's take it up a notch on that ladder of complexity. Let's talk about an institutional-grade strategy. This is how the pros can take an entire portfolio of properties and basically turn it into a stock by creating a real estate investment trust, or a REIT. Just think of a REIT like this. You're taking a whole bundle of properties, could be apartment buildings, office towers, you name it, and you're packaging them all up into a single company. The shares of that company can then be bought and sold on a stock exchange, just like Apple or Google. It's really the ultimate way to make a bunch of illiquid buildings completely liquid. Okay, this slide is super helpful. It puts the two strategies head to head. A strategic refi? That's your weapon of choice for a single asset, where your goal is to pull out cash tax-free while keeping total control. A REIT, on the other hand, is for when you've got a big portfolio, and the main goal is creating total liquidity by selling off fractional ownership to other investors. All right. Buckle up, because now we're moving from the established playbook to the absolute cutting edge. We're about to explore what could be the single most revolutionary shift in real estate investing we've ever seen: tokenization. And look, this isn't some far-off sci-fi fantasy. As the economist Dr. Pooyan Gamari says right here, tokenization is the breakthrough that finally cracks the code on real estate's oldest and biggest problem: the fact that it's so darn illiquid. So what are we actually talking about here? In the simplest terms, you're taking the ownership of a physical building and you're splitting it up into tiny digital shares, or tokens. These tokens live on a blockchain, which is just a super secure, transparent digital ledger. And suddenly, you can buy and sell a piece of a skyscraper as easily as you can trade a stock on your phone. And the advantages here, honestly, they are an absolute game changer. We are talking about a global real estate market that's open for business 24/7. Transactions that settle in minutes, not months. Imagine needing some cash and just selling off, say, 10% of your building on a Tuesday morning. It's that simple. This blows the doors wide open for investors all over the world. So what this all adds up to is something that has never, ever existed before: a true global secondary market for real estate. All of a sudden, that static, illiquid building on the corner becomes a dynamic, living, tradable asset. It's a massive shift in how we even think about owning property. So, this is all great, but what does it actually mean for you? How do you put this into action? Let's boil it all down into a practical blueprint, the modern investor's playbook that you can actually use.
Principle number 1, and this is crucial: model everything early. From the day you even think about buying a property, you should be using financial modeling software to run the numbers on all your options. Know the net present value of a sale versus a refi versus tokenization so you can always pick the most profitable path.
Number 2, you have got to optimize for taxes. Always. Your goal isn't just to make the most money, it's to keep the most money. That might mean using a 1031 exchange to defer capital gains or doing a strategic refi to pull out that tax-free cash. The less you give to the tax man, the more you have to build your empire. Okay, third principle, compliance is king. Especially if you're thinking about big moves like a REIT or tokenization. You have to do it right. Using tools like smart contracts creates a perfectly transparent, auditable trail of ownership. And that's exactly the kind of thing that attracts the big money institutional investors. And last but not least, number 4, time the market. It doesn't matter how brilliant your strategy is if your timing is off. You've got to use economic data, keep an eye on the cycles, and plan your exit for when the market is hot and valuations are at their peak. And all of this really leaves us with one final, kind of mind-bending question, doesn't it? If we can tokenize any asset, a building, a famous painting, a vintage car, what does it even mean to own something anymore? The very definition of ownership is changing right before our eyes. Definitely something to think about. Thanks for joining me.